Okay, here's our chapter 6 video. I think I'm gonna try and split this into two so that it's not too long, but we're moving into the statement of cash flows now. And this is the financial statement that we kind of skipped in 101. We talked about income statement, balance sheet, and statement of owner's equity, and then we kind of skipped this one. So this is what a statement of cash flows looks like. This is the whole thing. So I'm going to kind of start big picture, and then we'll talk about each of the sections, and then put it all together at the end. But we use the statement of cash flow for several different things. We use it to predict future cash flows, and generally, looking at what we had in the past is generally a pretty good indicator of what we'll have in the future, making some arrangements, just the same way you would look at your own previous budgets and see, to predict your future cash flows. We can also use this to evaluate decisions. So decisions on how well investments are doing, or operating decisions, because we can see these kind of different sections here, which we'll talk about in a second. And the other thing we will use is to you can look at the statement of cash flows to predict the ability to make debt and or dividend payments. So internal managers would like to be able to predict cash flows and evaluate decisions, but external people like potential investors or potential lenders would like to predict cash flows, evaluate decisions, and I want to make sure before I loan you any more money, that you're going to be able to pay me back. So we have 3 sections here. We have the operating, we have the investing, and we have the financing. So we're going to talk about each one of those separately, and then we'll kind of put them all together at the end. There are 2 different methods of the statement of cash flows. The indirect method, we start with net income, and then we try to kind of back into our ending cash balance. So we start with our net income off of our income statement, but remember, we counted the revenues and the expenses there when they took place. So that's not going to match our cash, because I might have made the sale this year, but I don't get paid for it till next year, and the same thing with liability. So because I use the accrual basis in my income statement, that's not going to match what my cash is. So I'm going to try to back into that. The ending cash balance I would get off my balance sheet, and we are going to use in this chapter what's called comparative balance sheets. If you remember when I took you to the website to show you GM's, General Motors balance sheets, it had several years worth. That's a comparative balance sheet. And so I can just say, okay, the end of last year and the end of this year, how much did that change? And so I'm comparing the 2 balances. And we'll get to that in a little bit here too. The direct method kind of restates the whole income statement in terms of cash. And so it'll show all the cash receipts and payments. Receipts and payments. That was kind of long. It's not used as often. That's in the appendix. We are not going to use that one. We are going to focus in this chapter on the indirect method. I just wanted to show you that there's 2 different methods for doing that. Okay, those 3 areas on the cash flows. The operating activity will show us cash flows that are related to current assets, current liabilities, and then things from the income statement. So revenues and expenses, we always start with net income, which summarizes those revenues and expenses, but then we'll have a couple other little things from the income statement there. The other things that we'll have to worry about are depreciation, gains, and losses. Again, all that would be from the income statement. So current assets, current liabilities, and anything from the income statement goes under the operating section. The investing section is cash transactions related to long-term assets. So this would be property, plant, and equipment, and any long-term investments that we have will go under there. And then financing activities, that section will show us anything related to long-term liabilities and anything related to equity. So basically when we're looking at these, you just have to know what type of account it is, and then you can figure out which section it goes into. There's another thing, a non-cash investing and financing. So these are transactions that had a big impact on investing or financing but were not cash. So for example, I bought a building but I didn't pay cash for it, I just issued a notes payable, or I borrowed money to do it. So that'll affect your investing and financing, but there's no cash here. Or somebody gave me a building and instead of paying him cash, I paid him in stock. So that would affect equity and long-term assets, but there's no cash. So those things are going to be listed either on an appendix to the statement of cash flows, or just a note in the financial note on the financial statements. The financial statements generally have a lot of notes explaining here's how we calculated our inventory, or here's how we calculated our depreciation expense, since there's different ways to do those. So there'll just be a note, because otherwise things aren't going to quite add up, because they're like, well, according to the cash flows it's this, but then you've got an extra $1 million in assets. So this just kind of reconciles that, but we won't really have to do too much about that one. This is a picture from your book. Just kind of giving you some ideas of the cash inflows and outflows. In general, if you're purchasing stuff, that's money going out, and if you're selling stuff, that's money coming in. That's pretty straightforward for investing and financing. We will, cash flows from operating is a little bit different, but again, remember this is current assets, current liabilities, and then also anything from the income statement. This will be, investing will be long-term assets, and financing is long-term liabilities and equity. Okay, so let's talk about cash flow from operating. This is actually kind of the toughest one, and there's some problems in the demo problems if you want to practice, which category it goes into, and that kind of thing. Cash flows from operating is actually the trickiest one, I think. The other ones are pretty straightforward, but so basically, if there is, and again, a lot of this is looking at comparative balance sheets. Comparative balance sheets. If there is an increase in the balance of a current asset, that means there is a decrease in cash. I think it's easiest to think of examples, like think about merchandise inventory. If the balance in merchandise inventory went up, that means you bought stuff, and so you had to pay cash to get it, so cash is going down. If there is a decrease in the balance of a current asset, then there is an increase in cash. If merchandise inventory balance is going down, that means you sold the stuff, so you got cash. Or think about accounts receivable. If the balance in accounts receivable is going down, that means people paid you, so cash went up. So with current assets, they work in the opposite direction. If there is an increase in the balance of a current liability, that is an increase in cash. And so these guys work in the same direction. If there is a decrease in the balance of a current liability, that is a decrease in cash. So think about accounts payable. If the balance in accounts payable went down, that means you paid on it, so cash went out as you made that payment. So With assets, they work in an opposite direction. With current liabilities, they work in the same direction. There's three other little things that we have to worry about here. We start the operating section, we always start with net income. And there are three things that we have to make adjustments to. One of them is depreciation expense. So when I calculated my net income, I subtracted depreciation expense from my revenues, but that was not a cash item. So I need to add that back in because I'm trying to reconcile. The whole thing I'm trying to do now is reconcile that net income to that cash balance. So because I've already subtracted that out of the net income, but that wasn't a cash thing going out, I need to add that back in. The other thing, which will get a little bit confusing, are gains and losses. So I report gains and losses on the income statement, and then because on the balance sheet, I just had the asset. But in this example, let's say I sold a piece of land and I had a gain on that sale, or a piece of equipment. Let's say it was worth $20,000, I sold it for $25,000, so I have a gain. That entire $25,000 in cash is going to get reported in the investing section for the sale of the land. So I don't want to include the extra $5,000 over there and in the net income. So because I'm only worried about the cash amount, and the entire cash amount is going to be included over in the investing section when I sold it, I need to kind of back that back out again too. So if it was a gain, I would have added it to my net income, so I need to subtract that. And if it was a loss, I would have subtracted that from my net income, so I need to add that back in. If I don't make that adjustment, I will have double counted it because I'd be counting it in investing and in operating. So those are the adjustments I have to make for those. So let's do one of those. I actually have two in the demo problem, so I'm going to... Oh, that's right. I forgot about this problem. So this is a good one. For each of these, you're going to say which section it goes into and whether it's increasing or decreasing. So increase in accounts payable, that's a current asset, right? So I know that goes on, it's current liability. I know that goes under operating because it's a current liability. It's an increase, and liabilities work the same way, so that's an increase to operating. So payment of dividends. Dividends is an equity, so that's financing, and I paid money, so that's money going out. Accrued liabilities, again, is a current liability, so that goes under operating, and since it's a liability, it works in the same direction, so that'll be a decrease. Issuance of common stock. Stock is part of equity, so that's finance. And if I issued stock, that means I got money. I sold it, right? So that's money, that's an increase. Gain on the sale of the building. So the sale of the building itself would show up in investing, but the gain is that thing that I have to back out. So that goes under operating, and if it's a gain, I need to subtract that back out, because I would have added that in, and so I need to take that back out. Same thing over here, the loss on the sale of land. The sale will go under investing, but the loss, I need to add that back in. Depreciation expense is always an addition to operating. Increase in merchandise inventory. Merchandise inventory is a current asset, so that's going to be under operating. And remember, with assets, they work the opposite. So then this is an increase. I need to decrease that here. Decrease in accounts receivable. Again, accounts receivable is a current asset. So current assets go under operating, and if it's an asset, they work in the opposite direction. So since this is a decrease, I'll add that back in. And then the purchase of equipment. Equipment goes under investing, property, plant, and equipment, long-term assets. And if I bought it, that meant money's going out. So there's a problem in the homework like this, or you can kind of try it again on the demo problems before you get to the homework if you want. Okay, so here's a problem where we're going to make this section of the for this part we're just going to do the the operating section of the statement of cash flows, which means we don't need all of these, right? So what do we need for operating? So we don't need the cash receipt from land because that's going to go under investing. I do need depreciation expense. Cash payment of dividends, that would go under financing, so I don't want that one now. Issuance of common stock is financing. Net income I need because that's always my starting point. Equipment, that will go under investing, so I don't want that one. And current liabilities I need, and current assets I need. So we always start with cash flows from operating. And then I always start with net income, which is 62,000. And then I'll do, I think the real title of this line should be adjustments to reconcile net income to cash provided by operating activities, but I will just say adjustments from operating activities. First thing I always do is add back in that depreciation expense. That's a plus, so I add that here. And then I've got increase in, let me move this over a little bit. Increase in current assets. And what they did is they took all of our current assets and lumped them into one thing for us. So instead of doing increase in accounts receivable, decrease in merchandise inventory, instead of doing all the current assets, they lumped them all together in one. So increase in current assets is 26,000, but because it's current asset, they work in the opposite direction, right? So if that's an increase, let's say it's merchandise inventory, that means cash went out as I bought that. And then I have a decrease in current liabilities. And again, liabilities work in the same direction, so that is a negative 18,000. Put all those together there, and I've got negative, what is that, 40,000? So the net cash flows from operating is 22,000. So even though my net income reported 62,000, my operating activities only generated 22,000 in cash. So the next one I want to do is kind of continues the same problem. Again, this is in the demo problem, so you can go along, but they want you to do the whole thing. So we essentially copy this and then add the investing and financing to it. So that's what I'm going to do here. So just to kind of, I probably should just skip that first one, but we're going to keep going. How's that? Cash flows from operating. I just kind of want you to see what the whole thing looks like. So again, I start with net income, which was 62,000. And then I do my adjustments from operating. This is going to be a little squished on here, but then I have a prettier version of this on the next slide. I just kind of want you to see me doing the whole thing here. So depreciation expense, I add that back in, so that's 4,000 positive. Increase in current assets, right? So that's a negative 26. And decrease in current liabilities was 18,000. That's this one. So that was the negative 40. And so net cash flows from operating was 22. Then as a separate section, I will do cash flows from investing. And we said we had two of those, right? This one was investing, operating, and we had two from investing, right? We had the purchase of equipment and the sale of the land, and then, oh, that's operating too. And then these two would be financing. So I've got cash purchase of equipment. That's money going out, right? Because I bought that, so that was the 36,000. And then cash receipt from sale of land. So that's that guy, and then that's that. So that's positive because I sold it. So my total over here is negative 10,000 net cash flows from investing. And then I'll do cash flows from financing, which will be my long-term liabilities and my equity, and I have two of those, right? So I have cash receipt from the issuance of common stock, so that's money coming in. So that's 25,000 positive. And then I have cash payment of dividends. That's that one. So that's 56,000 negative. So my net cash flows from financing activities are 19.4 positive. So then I need to put these three sections together, the 22, the negative 10, and the 19 floor. So I have net increase in cash for the year would be those three numbers together, so I've got 31,400. Then what I'm trying to do is reconcile that. So I started with a cash balance of 23. So my cash balance at the last day of last year and the first day of this year are the same, right? So my cash balance the last day of last year, so in this case it's April 30th, for 30/16, was 23.3. So that total is 54.7. And that should equal my ending cash balance this year, which it does. Cash balance, oh sorry, this was 15. Last year for 30/16 this year. And so that is how I've reconciled the net income to the ending cash balance. So I started with 23.3 in cash. I increased my total cash by 31.4 this year, which leaves me with 54.7. So this is my ending, on my balance sheet. And when they look at these, increase in current liabilities, decrease in cash, that came from comparing the balance sheets. The rest of these, they're kind of telling you what happened. Now, sometimes they don't come right out and tell you what happened. You have to kind of figure it out. But I'm going to save that for the next video, I think. This is just a prettier version of that one. So here's our net income, operating, investing, financing, put them all together. Here's your increase in cash. Here's what you started with. So this is your ending cash balance. So that's how I start with my net income and back into my ending cash balance for the year. So, okay, I think I'm going to stop that right there and then come back and show you what happens when they don't tell you what like for instance, they don't tell you how much they paid in dividends, how you can kind of figure that out by comparing the balance sheets. So the next part will be a little bit more on that comparative balance sheets for you. Let's keep that, and let me post this guy, and then I'll start another one.